So again, today we are going to be looking at portfolio theory, and we're going to talk about the meaning of portfolio and portfolio management. We're going to talk about the modern portfolio theory, efficient frontier, risk-return trade-off, portfolio risk, the types of risk, portfolio diversification, and how to mitigate portfolio risk through diversification. Not only that, I will also demonstrate for you how to determine portfolio return, as well as the relationship between securities in the portfolio, which represent the correlation coefficients. There are other concepts in portfolio, but we are not going to do much on that. After all the relevant discussions, I will demonstrate how to calculate portfolio risk, portfolio return, as well as the correlation coefficients. So there are other concepts in portfolio you need to know about. Okay, so when we get there, we'll ask you, I will tell you what to do. But for now, let's take it one after the other because of time. Therefore, what do you understand by portfolio? You see, when you say, for example, let's say we will have shares, we have bonds, okay, we have energy, we have commodity, there's real estate, okay, there's real estate, there's an exchange traded fund, we also have mutual fund. So let's limit to all to what we have here. Now, when you talk about portfolio simply means the collection of several investment instruments, such as stocks, shares, and other similar securities. Okay? And that is what portfolio is all about, the collection of several investment instruments like shares, bonds, commodities, and other similar securities. That is what portfolio is all about. But when you talk about portfolio management simply means the art of building and managing several investments, instruments that is consistent with the long-term goal and risk tolerance of investors. That is portfolio management. I take it again. The portfolio management represents the heart. When I say heart, A-R-T, the heart of building and managing several investment instruments that is consistent with the long-term goals and risk tolerance of investors is what is called portfolio management. So the modern portfolio theory stipulates that investors should not only focus on the securities in the portfolio. All what you have here, all these investment instruments, they are the securities in the portfolio. Let's say this circle represents basket of investments. So all the securities you have in this basket are what we call portfolio. Therefore, the modern portfolio theory stipulates that a rational investor should not only focus on the securities in the portfolio, but they should also consider the relationship between or among the securities in the portfolio. That is, they should consider how the securities relate to one another, because that is very important in minimizing portfolio risk. All right. So not only that, the modern portfolio theory is a theory or a concept that is based on how a risk-averse investor can construct a portfolio, okay, can construct a portfolio in order to minimize a portfolio risk, okay, in order to minimize a portfolio risk, because a risk-averse investor or a rational investor believe that if you give if you give a rational investor a high level of risk, he or she will expect a high level of return, and vice versa. However, where two securities have the same level of risk return, the investor will select the security that has a lower risk. I will take it again. Given a rational investor a high level of risk, he or she will expect the security, or he or she will expect a high level of return. And where two or more securities have the same level of risk or of return, they will expect the same level of, we will select the one that has a lower risk. This statement can be demonstrated in the efficient frontier graph. All right. In the efficient frontier, let me see if I have it. Okay, it's not here, but let me just, okay, let me just see if I can do it here. Now, let me construct the graph. So here is return. Here is risk measured by standard deviation. So let's say we have return level 1. There is also a return level 2. We have standard deviation G1, standard deviation G2. Okay. Let's see. This will join here. This will also join here. Okay. So let's say at this point of intersection, let's say this is security A. This is another point of intersection. Let's say this is security B. There is another point here. Let's say this is security C. So this is called efficient frontier. Okay. Now, like I said the other time, that given a rational investor a high level of risk, he or she will expect the same level of a return. And where two securities have the same level of return, we select the one with a lower risk. That particular statement can be demonstrated in this efficient frontier. When you look at this graph, security A and B are the ones security that lies on the efficient frontier, which are the most preferred security. Now, in case you are asked to explain modern portfolio theory, because these are the things you are going to be talking about. If you're asked to explain modern portfolio theory, after you have given the meaning of, what the theory is all about, then you need to talk about the fact that investors do not like risk, okay? There's no investor that like to take risk. However, given a rational investor a high level of risk, he or she will expect the same level of return. And where two securities have the same level of return, we select the one with a lower risk. So that particular statement is demonstrated in this efficient frontier. From this graph, you will notice that at R1, at return level 1, you notice that security A and C lies on the R1 on return level 1, but at different level of risk. Security A has risk level D1, security C has risk level D2. Therefore, but because of the fact that security A and C falls on the same level of return, security A will be preferred over security C. Because if you look at it, you see that since they have the same level of return, but security C has a higher risk, D2, relative to security A. Therefore, security A is preferred over security C. That's on one side. When you look at security B and C, you will notice that security B and C fall on the same level of risk, D2, but different level of return. Security C has return R1. Security B has return R2. But because they have the same level of risk, then security B is also preferred over security C, because security B and C, they have the same return D2. Sorry, the same risk D2, but different level of return. So at this point, security B will be preferred over security C. Now, where two securities, security A and B, are preferred over security C. Security A and B are preferred over security C. Therefore, where two securities are preferred over the other, where a security is preferred over the other security, then the preferred security is said to possess a stochastic dominance. This is stochastic dominance. Okay, so what this simply means is that security A and B that fall on the efficient frontier possess stochastic dominance over security C. So the choice is now between security A and B. Since A and B is preferred over security B, so you need to make a choice. A rational investor will need to make a choice between security A and B. Therefore, a risk-averse, you can see that security A has a lower risk and a lower return. So a risk-averse investor will prefer will select security A. A risk-averse investor is an investor that will not like risk. All right. Therefore, generally, a risk-averse investor will want to minimize his risk. So therefore, a risk-averse investor will select security A that has a lower risk with a lower return, whereas a risk-aggressive investor will choose security B because security B has a higher return with a higher risk. So this is how to explain the efficient frontier in relation to modern portfolio theory. Now, that is on one side. Let's talk about risk-return trade-off. Risk-return trade-off. So the risk-return trade-off simply means the positive relationship that exists between the expected return as well as a systematic risk, which states that a higher return is not really possible. I mean, a higher return is not possible to attain in an efficient market. Okay, an efficient market is the one whereby the relevant information is available. Nothing is hidden to investors. Okay, all investors, the market participants, they are aware of the information, of the available information. All right, nothing is hidden to investors. So the risk return trade-off is saying that a higher return may not be possible, okay, to attain in an efficient market, especially over a long period of time without accepting a higher risk, okay? So that is what risk return trade-off is talking about. I will repeat, a risk return trade-off is a concept that refers to the fact that a positive relationship do exist between expected return as well as the a systematic risk. That's what we are saying the other time, that the higher the return, the higher the risks, and vice versa. Okay? So because of the fact that higher return is not possible to attain in an efficient market over a long period of time without taking a higher risk. All right? Then, before we go to portfolio diversification, let's talk about portfolio risk. Let's talk about portfolio risk. The portfolio risk is a chance that the actual return may be different from the anticipated. You know, before you commit your limited scarce financial resources on any investments, you would have anticipated that, okay, you are going to earn, say, a return on investment, say, for example, a 10%, maybe 10% to 15% or 20%. You must have your own targeted rate of return. That your targeted rate of return simply represent your expected or anticipated rate of return. So that's expected rate of return may be different from the actual return you are going to earn at the end of the day. Therefore, when you talk about portfolio risk, it simply means the chance that actual return may be different from the anticipated. This also means that the original investment or parts thereof may be eroded. That's what happened in 2008 during the economic meltdown, when investors lost so much on their investments when the market crashed in 2008. And in recent time, I think in 2021 or 2022, similar thing occurs, but it wasn't as terrible as in 2008, okay? So when you talk about portfolio risk, of course, standard deviation is used to measure portfolio risk, and the higher the standard deviation, the riskier or the more risky is the security, okay? Now, what are the types of risk? What are the types of risk? There are basically two types of risk. One is systematic risk. We also have unsystematic risk. What do you mean by systematic risk? The systematic risk is also known as beta, unavoidable, market imposed, general, non-diversifiable risk. Is a kind of risk that investors will like to pay in order to avoid, but that is not possible because systematic risk is going to affect every company, every individual in the economy. Like what happened in 2020 during the pandemic, is noticed that during that time, the entire world was under lockdown for an extended period of about 6 months. Businesses could not operate the normal way. All right. So we have to adapt to new normal, you know. So that's a risk because people have invested at the beginning of the year that they anticipated to achieve so much, but the COVID-19 came in and all the plans were altered. Okay, this is what we are talking about. So when you talk about systematic risk, it's a kind of risk that is non-diversifiable. You can't shift it to anyone. You have to bear it. It is non-diversifiable. It is unavoidable. It is general. It is market imposed. It is when you say non-specific, non-specific, it means it is general. So, however, the systematic risk can be eliminated through diversification. Okay? The systematic risk can be eliminated. It cannot be eliminated through diversification, unlike unsystematic risk. There's no way you can eliminate systematic risk. That's why I said that it is market imposed. Everybody will bear it. All right? The only thing you can do against systematic risk is to hedge. You can only reduce it, but you cannot eliminate. You can only reduce the risk. So what are the types? What are the events or reasons or causes of systematic risk. One is one I mentioned the other time, pandemic, which is COVID-19. Two, war. Three, economic meltdown or recession. Then four, of course, there's inflation, then interest rates. All of this will have impacts on the economy, to also have impact on businesses, on investments. So these are the events or the reasons for systematic risk. Okay? Now, what do you understand by unsystematic risk? The unsystematic risk is a kind of risk that is peculiar to a particular company in the industry. It's a kind of risk that is peculiar to a particular company or industry within the economy. It is also known as specific, non-market imposed, diversifiable, alpha, unique risk. So the unsystematic risk is diversifiable, it is avoidable, and it is usually caused by an event such as poor management, product recall. That takes me to some years back. You remember, about 3 or 4 years ago, there was a time that Samsung products, a particular model of Samsung, was generating hits, and the company has to make a recall on that particular model. I think Galaxy X, something. I can't remember the name of the model of the phone. You know, that particular action resulted to financial losses to Samsung. Other companies in the industry did not face that similar risk. That is what is called unsystematic risk, because it is peculiar to Samsung. That particular risk does not affect every other companies in the industry. Company like Apple, okay, company like Apple was not affected by that product recall. So each company has different management team. Okay, each company has different management team. Therefore, and the quality of each management differ, especially when there's a change in management. So that may affect the ability of the company to take advantage of market condition. Not only that, when there's regulatory change, any regulatory change is peculiar to peculiar to an industry. All right. For example, let's say in manufacturing, there's a regulatory change in manufacturing industry. So all that means is that every other industry, like say for example, the service industry, or let's say the oil and gas. Okay, the oil and gas, which they are not affected with that change. So that means they are not going to be affected. So, but when you talk about regulatory change, when that is currently happening in Nigeria, few days ago, in fact, just yesterday, the Central Bank of Nigeria announced the recapitalization of banks in Nigeria. So that's a change in the banking industry. Other industries are now affected with that change. So whenever there's a change, there's usually a risk. Now that there's a recapitalization in Nigeria, in the banking industry in Nigeria, you will see that the banks, the banks will start looking for how to meet up with the deadline, for the recapitalization. Okay, they will be sourcing for how they can get the finance to meet up with the deadline. Not only that, what are the investors? What do we need to do to raise money for us to be able to meet the targets? So these are the things we are talking about. These are the things we are talking about in relation to unsystematic risk. All right. So these are, you can just read them through. So just go through all of them to have the understanding. Okay. Now let's talk about portfolio diversification. Let's talk about portfolio diversification. The portfolio diversification is a kind of strategy that is usually deployed by a rational investor by spreading the limited scarce financial resources among competing investments, such that if one investment is not doing well, there will be other to fall back on. Okay? The portfolio diversification helps a rational investor to avoid a disastrous financial end. This is because when you spread your investment, say for example, you have 100 billion naira, let me cut it. You have 100 million naira that you want to invest. So portfolio diversification is saying that please don't put all this money on a particular security. Instead, you have to spread it. Some percentage of this 100 million should be invested on stocks or shares. Part of it should be invested on bonds. Part of it should be committed on real estate. Part of these investments should be committed on commodity, and so on and so forth. This is what portfolio diversification is teaching us, because it is possible. I mean, there is no how all these insecurities in the portfolio will react to market conditions in the same way. It's not possible. They are going to react to market condition, or they are going to react to market gyration in different ways. So as a result, this is what portfolio diversification is teaching us. That is, a rational investor should not put all his or her eggs in one basket. Rather, spread it across. That is essence of portfolio diversification. Portfolio diversification will help a rational investor to hedge or to minimize the portfolio risk, because the securities in the portfolio, if well diversified, will not react to market condition in the same way. All right, that is essence of diversification. Now, how do you minimize portfolio risk? How to minimize portfolio risk? To minimize a portfolio risk, investors should invest in securities that are negatively correlated, or security with no correlation. Not only that, portfolio diversification will help a rational investor to reduce risk, to reduce portfolio risk by engaging in international diversification or geographical diversification. What do you mean by international diversification? Now, even though you have your investments scattered in Nigeria, for example, you should also try as much as possible to take some percentage out of Nigeria. In case if there is issue in Nigeria, the one you have invested elsewhere outside Nigeria will still be there. That is what is called international diversification. Geographical diversification means that instead of concentrating your investments in a particular location, say for example, this 100 million naira is invested entirely in Lagos. The risk of that is that if there is an issue in Lagos, that means the entire investment may be eroded, or part of it may be eroded. And that's why it is important to also have to consider geographical diversification. So if you have investment in Lagos, there's nothing bad if you have part of it. Also, we also invest in the east. Say for example in Enugu, you invest part of it in the north. Say for example in Kano, in Kaduna, and all of that. You also have part of it in the west, maybe Ibadan or in Ekiti. However you want to do it, just have geographical diversification. Okay, so look at, there's something happened in the oil and gas industry about in 2017 or thereabout. I can't remember the exact date. around 2017, during the time of Jonathan, when there was during the time of President Jonathan, the former president of Nigeria, that was when the militancy issue was were very tough. I mean, it was very tough in the South. So in the IOCs, the international oil companies, generally they operate in the field. The field is where they do their production, exploration, and all of that. But their head office is in Lagos. Their head office is in Lagos. Therefore, during that period, their field operation was, was shut down for a complete 1 month. They could not operate on the field because of the militancy. They could not operate on the field. It was a huge loss to the companies. But because of the fact that they also have head office in Lagos, so they were able to minimize the risk. You cannot imagine if their head office, including the operation, the field operation, everything is located in the south. That would have been a very huge loss to the companies. And that's why this is what we are saying, that you should consider geographical diversification. You will notice that some banks in Nigeria, banks like Access Bank, GTB, and the likes, they also, despite the fact that they have so many branches in Nigeria, they also have across West African countries, even including the UK. Okay, they also have branches in UK. This is diversification we are talking about, all right? Because there is no how those securities within the portfolio will react. That's if a well-diversified portfolio will make the securities to be resilient to gyration. Gyration means fluctuation. So when there's when the market is volatile, when there's a change, there's fluctuation in the movement of the security, of the price of the security. So because of the fact that you have diversified your investment, the risk that you are going to bear will be very minimal. So that is portfolio diversification. Please read through about them. Now, there is a particular story, because the essence of portfolio diversification, like I mentioned the other time, is to minimize portfolio risk, and the portfolio diversification teaches a rational investor not to be over-investing in a particular security. Not only that, it also helps us, the portfolio diversification helps us to avoid a disastrous financial end by not putting all one's egg in one basket, okay? So that's essence of portfolio diversification. Something happened about 22 years ago or thereabout, specifically in 2002, when Enron collapsed. Enron, as at that time, in the early 90s up to early 2000, Enron was, say, number 1 to 5, one of the top 5 big companies in the world, because of course, but the trouble started for the company in early 2002, and as of June in 2002, the company collapsed, could not survive it. But prior to that, before that period, the share price of the company was sold for, was around $90. Okay, the share price of Enron was around $90. As at that time, you can imagine, over 20 years ago, was $90. And because of the high performance of the company in the market, most of the company's former employees and retirees invested so much in the company's shares. They invested so much in the contributory scheme. So apart from their normal contribution, that's, for example, the pension contribution and all of that. So they also invested in the company shares. So, but the trouble started for the company in the early 2002, and the share price that was around $90 fell almost to nothing. So you cannot imagine the retirees that was expecting that at old age, I should be having a stream source of income to take care of my needs. You know, you can imagine such investor. What could be their fate? Because they put all their eggs in one basket, because as at that time the company was doing well. They believe that the company will continue to do well for the foreseeable future. But the unexpected happened. They lost their money. Some of them, they lost millions, thousands of dollars, hard-earned money. This is what we are saying. The fact that the company is doing well today does not mean that they will continue to do well tomorrow. So you have to take a caution. If you have 500 million naira or a particular sum of money that you want to invest, please don't put it on one particular security. You have to spread it across. You have to spread it across, irrespective of the performance of the company, the current performance of the company. It's important for you to diversify your investment so that you don't lose everything. This is essence of portfolio diversification. Now, what are the types of diversification? There are majorly three, but you can read all of this in the material. So you can read this. So let's talk about the other time I've already talked about how to reduce portfolio risk. That is, to reduce portfolio risk, a rational investor must invest in security that are negatively correlated or security with no correlation. All right. So you can read all of that. Okay. Now, I told you let's talk about estimating, calculating portfolio risk, return, and correlation coefficients, and correlation coefficients. Okay, so I've already defined for you what portfolio risk is all about. I said that portfolio risk is the chance that, is the possibility that the actual return may be different from the expected return. Okay, it may well be that the original investment or part thereof may be eroded. May we never experience that. Okay, so that is portfolio risk. Therefore, how do you calculate portfolio risk? Before you can determine portfolio risk, we need to determine the risk of individual securities in the portfolio. So, estimating portfolio risk. So we are getting close to the calculation. Estimating portfolio risk. So how do you calculate portfolio risk? You need to know how to calculate the risk of individual security. Risk of individual security in the portfolio. Okay? How do you estimate the risk of individual security? Say, for example, you have two assets security, two asset portfolio, A and B. You have two asset portfolio, A and B. Therefore, when you want to calculate the risk of individual security, what is the risk of security A? What is risk of security B? So to calculate the risk of individual security, standard deviation of security A is calculated as the square root of variance. And variance is calculated as summation of probability of X minus, sorry, we are using A. Probability of A okay. Let me stop sharing this and move to a working notes. let me know if you can see my screen.
We can see it, sir.
Can you see my screen, please?
Yeah, we can see it, sir.
Okay, thank you. So like I was trying to say, estimating portfolio risk. How do you calculate portfolio risk? First thing first, you must know how to estimate the risk of individual security. Risk of individual security in the portfolio. Say, for example, you have two asset portfolio. Two assets portfolio. Security A and B. Therefore, the risk of individual security would then be standard deviation of security A will be equal to the square root of variance. And variance is summation of probability of A minus A bar all squared. So this is the formula to calculate the risk of individual security. So you do it separately. You calculate the risk of security A, you also calculate the risk of security B. Now, I can then go ahead to calculate the risk of the portfolio. There are two ways you can calculate the portfolio risk. You can either use general formulae or you use tabulae method. Whichever one that you use, you are going to get the same answer. Say, for example, you want to calculate portfolio risk using the general formula. Therefore, I would then say portfolio risk. Of course, is denoted as a DP. The portfolio risk we calculated as the proportion invested on security A. You square the proportion. Say, for example, you have 100 million naira that you want to invest. You want to invest this 100 million naira onto security A and B. Therefore, you are saying that you want to invest 60% on security A, then 40% on security B. So that 60% is the proportion, is the weight of the amount invested on security A. So when you want to calculate the risk of the portfolio, the WA square represents the weight or of the amount, the proportion invested on security A, multiplied by the variance of security A plus the proportion invested on security B, you square it, multiplied by the variance of security B, plus, because there are two asset portfolio, therefore, multiply by, open a bracket, the proportion invested on security A, multiplied by standard deviation of security A, multiplied by proportion invested on security B, multiplied by standard deviation of security B. All of this multiplied by the correlation coefficients between security A and B. So, of course, once you have this done, you need to square it. So this is the formula for calculating portfolio risk. If it's a 3-asset portfolio, then, of course, when you get to this point, you need to introduce the proportion invested on security C multiplied by variance of security C, then plus 3 multiplied by the rest. But in this our formula, we're assuming that it's a true asset portfolio. So that's that. Okay. So this is how to calculate portfolio risk. Now, that's additional formula you need to know. We need to know, what do you understand? How do you calculate portfolio return before we come to correlation coefficients? So how do you estimate portfolio return? You're not hearing anything. Hello, can you hear me?
Yeah, we can hear you,
We
sir.
can hear you,
The
sir.
voice is
So
loud.
somebody is saying that you can't, the person is saying that you can't hear me. Okay, if you can hear me, let me just continue. Okay then. So let's talk about estimating portfolio return. Estimating portfolio return. Now, when you want to estimate portfolio return, excuse me, just like you determine risk of individual security, you must also determine the return of individual security. Therefore, how do you calculate the return of individual security? For return for individual security, return of individual security. Okay, so the return of individual security, which is RA, the expected return, will be calculated as summation of probability of A. To get the return of individual security, you are expected to multiply probability with the possible outcomes in terms of a return. Say, for example, for security A, you are given a probability of, say, 50% for the first state of nature. You're also given 30% for another state of nature, and you are given a 20%, so which is equal to 1. Then you are now given return of security A. Say, for example, for simplicity, say this is 1,000, this is 500, then this is 800. So for you to now get the expected return, you are supposed to multiply probability with the return of the security. Therefore, you need to calculate your expected value. You then say 50% of 100, that will be 500. 50% of 1,000 rather, that will be 500. 30% of 500 will give us 150. Then 20% of 800 will give us that should be 160. Then when you now add everything together, that should be around 810. This 810 is what is called expected bar. In this case, that will be A bar. So the expected return of individual security is calculated as probability of A. That is, you multiply probability with the return of security A. This is how you are going to calculate it at the end of the day. This is how to calculate expected return of individual security. You do for security A, you also do for security B. If the security is denoted as X and Y, you do for security X, you also do for security Y. So this is how to calculate expected value of individual or expected return of individual security. Then what about the return of the portfolio? Then, of course, the expected return of the portfolio. Return of the portfolio, RP. The return of the portfolio is calculated as the proportion invested on security A multiplied by expected return on security A plus proportion invested on security B multiplied by expected return on security B. So when you add the two together, it will give the return of the portfolio. All right. Then finally, let's talk about how to determine correlation coefficients. Estimating correlation coefficient before we define the variables. Okay. Estimating correlation coefficients. R. What do you understand by correlation coefficients? The correlation coefficients measure the relationship that exists between the securities in the portfolio. All right. When you want to determine the relationship that exists between securities in the portfolio, then you need to calculate correlation coefficients. Okay. Like I mentioned the other time, that modern portfolio stipulates that a rational investor should not only focus on the securities in the portfolio, but should also consider how they are related. That correlation coefficient is talking about, that relationship is talking about correlation coefficient. So correlation coefficients measure the relationship that exists between securities in the portfolio. Therefore, how do you then determine the correlation coefficients? When you want to determine the correlation coefficient between security, which is R, your R is calculated as covariance between security A and B, because we are using two assets portfolio A and B. So if it is X, it will be X and Y. So divide by standard deviation of security A multiplied by standard deviation of security B. So this is the formula for calculating correlation coefficient. Covariance between security A and B divided by standard deviation of security A multiplied by standard deviation of security B. Now, before you can determine the correlation coefficients, you must understand the covariance between the securities. Covariance measures the linear relationship between two variables, okay? Covariance measures the linear relationship between securities, between two securities. So if that is the case, how do you then determine your covariance between security A and B? Covariance between security A and B is calculated as summation of probability multiplied by A minus A bar, okay, multiplied by B minus B bar. All right, B minus B bar. So, of course, this is how you are going to calculate you are going to multiply the three of them. Probability multiply with A minus A bar, you also multiply with B minus B bar. If your security is denoted as X and Y, then you multiply probability with A minus X minus X minus X bar, then Y minus Y bar, and all of that. All right. So that's for that. So this is how to calculate correlation coefficient and then covariance between security A and B. I repeat again that correlation coefficients measure the relationship that exists between the securities in the portfolio. So let me just define the variables before we begin to solve. So where we started from portfolio risk. So where dA is the standard deviation of security A, where dA equal to standard deviation of security A. Of course, dB will be standard deviation of security B. We're only going to recognize one. Then we also talk about which other variables you have there. Then we also have P, which represent probability. P equal to probability of occurrence. Then we also have DP. Of course, DP is the portfolio risk. This is portfolio risk, or the risk of the portfolio. Then we also have, after that, we also have WA. We have WA, which is the proportion invested or amount invested. Proportion invested in security A. WB will mean the proportion invested in security B. Then, of course, we have D2 square. This square, so which represents variance. This square equal to variance of each security. Then we also have R. R simply means correlation coefficients. We have R, which is correlation coefficients. Then we have covariance. This is covariance between securities A and B. What else? I think that's it. Okay, that's it. So these are the variables. I've defined them for you. So that's that. But there's something you need to know. In relation to correlation coefficients, note, when the probabilities of the securities in the portfolio are different, when, let me write that, when the probability of securities in the portfolio are different, it means there is no relationship. There is no relationship between the securities. That is, R is equal to 0. Okay? So say, for example, you have security A, you also have security B. You are then give probability. Say this is 0.5, 0.5, which is 1. Say, for example, security B, you are given 0.7, 0.3, which is also 1. Because the two securities have different probability, it means there is no relationship. It means there is no relationship. So if there is no relationship, your R will be equal to 0. So what this simply means is that when you want to calculate your portfolio risk, here where you're supposed to put R, since they have different probability, your R will be equal to 0. You are going to put 0 there. Okay? So you are going to put 0. So if this one is 0, that means whatever you are going to have entirely, all the entire figures you are going to have there will be equal to 0. Because that 0 would have depressed whatever number you have there. All right? So I repeat again, when the probability of securities in the portfolios are different, it means there is no relationship between the securities. That is, your R is equal to 0. But if the two securities have the same probability, it means there is a relationship. Then you must go and determine your correlation coefficient. Okay? So to get your correlation coefficient, you must first of all estimate the covariance between the two securities, because you are going to need the covariance between securities to estimate your correlation coefficients. Not only that, finally, if at all time, let me say this is 1. Let me clean this. Two. Okay. The return of the securities, the returns of each security must be given in percentage. Must be given in percentage. Okay. However, if the return are given in absolute amounts, are given in absolute amount, it should be converted. It should be converted to a percentage. Before calculating, it should be converted to percentage. Before calculating, expected return. So if that is the case, how do you then convert absolute amount of your return to percentage? So to convert return to percentage, then you say return at each state of nature. State of nature is the event in the economy. You can have good, bad, worse, high, medium, low, most likely pessimistic. You can have above, average, then below. Those are kind of the state of nature we are talking, the event in the economy, basically. Therefore, if your return is given to you in Naira or absolute amount, then you need to convert it to percentage, because you don't use absolute Naira or absolute amount to calculate expected return. You need percentage. Therefore, if absolute amount is given to you, you need to convert it to percentage. How do you then do that? So to convert absolute amount to percentage, you are going to pick the value at the end minus value at the beginning. Value at the beginning plus a space, then divide by value at the beginning. Of course, whatever you have to multiply with 100%. Okay? You have to multiply with 100%. So this is formula you are going to use to convert absolute amounts of return to the percentage. So I believe we have covered all the formulas that you need to do justice to how to estimate portfolio risk, portfolio return, and then correlation coefficient. So at this point, we can then have illustrations. Let's have illustration. Let me stop sharing this. Now, let me know, please, if you have any question for me so far. Before we dive into calculation, let me know if you have any question for me. Okay? Any question for me so far? If there is none, then let's move on. Let me share the So let's have illustration. Please make sure you go through this material so that you have deep understanding of the concept of the portfolio. So let's have illustration. Let's see. Illustration. Okay, let's start from illustration 1. Let's start from illustration 1. Chief Chukwumerije has the following portfolio of shares in 5 listed companies in Nigeria. So there are 5 companies: black, blue, yellow, purple, then white. The following data are given in relation to the shares. At present, the risk-free rate of return is 8%, while the market return is 14%. You are required to calculate 1, the beta factor; 2, the required return on the portfolio; B, explain the relevance of portfolio theory to Chief Chukwumerije. Now, what are you supposed to do here? Examiner wants you to calculate beta factor. Meanwhile, you already have beta factor in the question. Here is beta factor of individual security. So examiner is now asking you to calculate another beta factor. This beta factor the examiner is asking you to calculate represents the overall beta factor. That overall beta factor is the risk of the portfolio. When we get to capping, we are going to talk about estimating beta value. What is beta? How do you estimate beta? All right. But for now, let's go as it is. So, examiner is asking you to calculate beta value. How do you then estimate the beta value? There are 5 different formulas you can use to estimate beta value. So when we get to capping, capital Z pricing model, I will show you the entire 5 formulas which you can use to calculate your beta factor. However, one of them is that you are only going to use weighted average method. You use weighted average method, where in the question you are given number of shares, or let me even ignore number of shares. You are given market value, okay? You are given market value or market price per share or share price. You're also given the beta value of individual security. So the weighted average method is used where you are given market value as well as the beta value of individual security. All right. So at times, market value, the total market value may not be given to you. Examiner may give to you market value per share or market price per share, or simply put, share price. But if examiner has given you market value per share, the number of shares must be given to you. Like in this question now, you are given share price, you are given share price. Share price is 2 naira 50 kobo, which is this. You're also given number of shares. These are the number of shares. So you need to multiply the number of shares with the with the market price per share for you to be able to get your total market value. So beta value is also given to you in the question, which means that you are supposed to use the weighted average. So using the weighted average, okay, because of time. So this is what we want to do. So let's switch to the working notes. Let's switch to the working notes so that I can quickly solve that question for you. So illustration number 1, solution to illustration number 1. Okay. The name of the investor is Chief Chukwumerije. Okay. What are you asked to do? You want to determine beta factor, because in the question, examiner has given to us beta factor of individual securities. It means that you have to calculate, the requirement is talking about overall beta factor. Okay. Remember, beta value measures the risk in a portfolio. Therefore, to get the beta factor, what I need to do is to calculate the total market value of each security. I will calculate the total market value of each security. I will multiply with the beta factor of individual security to get the total weight. Then total weight divided by total market value will give me the overall beta. Okay. So if that is the case, I need to create a column for companies. Let me write this. So calculating beta factor. So like I said, there are 5 different ways of calculating beta factors, and you have to master the entire 5 formulas that you can use to calculate your beta factor, because this is where students usually find it difficult, especially under capping, because any one of those formulas may be applicable on the day of your exam. And that's why it is important for you to make sure that you understand you memorize all the 5 formulas, so that whichever one the examiner is bringing for you, you'll be able to do justice to it. So the first item here is a format. The first item here will be the companies in the portfolio. Then you create a column for number of shares, if given. Then create a column for market value per share. You create a column for total market value. You create a column for beta value of individual security. Then you create a column for the weights. Say this is A, this is B, this is C. C equal to A times B. This is D, then this is E. E equal to C times D. So we have security black, blue, yellow, purple, then white. So what are the number of shares? Please, if you have it open with you, you can just call them for me instead of switching between pages. So the first one is black, 15,000 shares for black. Here is 15,000 shares. What about blue? $18,000. Okay. Then 10,000, 12,000. 10,000, 12,000, then 20,000 for whites. Let's go and pick market value per share. You can see we have price per unit. That's not what we're looking for. That's not market price. The market price is given to us separately. Therefore, for black, 2.5, then 2.2. Here is 2.5, 2.2, then 1.9, 1.5, 1.9, 1.5, I think 1.2, 0.6, 0.60. So to get the market value, you multiply. So you then say 15,000 shares multiplied by 2.5, that's 37,500. 37,500. What's the beta value for black? 1.32. 1.32, 1.2. 1.32, 1.2, 0. 0.8, 0.80, 1.05, then 0.8. So you need to multiply. I would then say 37,500 multiplied by 1.32. That's 49,500. You do the same thing for blue. Blue is 18,000 shares multiplied by 2.2 equal 39,600. 39,600 multiplied by the beta value of 1.2 equal 47,520. 47,520. Go to the next one, which is yellow. Number of shares of yellow is 10,000 multiplied by 1.9. 1.9 equal 19,000 multiplied by 0.8. 15,200. Next one, purple. 12,000 shares multiplied by 1.5 equal 18,000. 18,000 multiplied by 1.05 equal 18,900. Lastly, whites. 20,000 shares multiplied by 0.6 equal 12,000. 12,000 multiplied by 0.8 equal 96. Therefore, we need to add. So we had, our focus is on the total market value as well as the total weight. Total. So bring out your calculator, let's do it together. 96 plus 18,900 plus 15,200 plus 47,520 plus 49,500 equal 147,20. 147,20. So you add up the market value, the total market value as well. So 37,500 plus 39,600 plus 19,000 plus 30,000 equal 126, 100, 126, 100. So once you have this, then you need to calculate your beta value. The overall beta value, denoted as B, will then be equal to total weight divided by total market value, which is equal to 140,720 divided by 126, 100. So what do you get? 140,720 divided by 126, 100 equal 1.115. So let's say 1.12. 1.12, because our beta value, our beta factor for individual securities is in 2 decimal place. Therefore, here will be 1.12. That represents the overall beta. I would then say the overall beta factor of Chief Chukwumerije portfolio, Chukwumerije's portfolio is 1.12. Now, when we get to valuation, when we get to capital pricing model, I will tell you more on how to, like I said earlier on, how to estimate beta factor, different ways of calculating beta factor, and then what is beta factor, what are the types of beta that you can have. So how do you compare the beta of individual security with the beta of the market? So we are going to, when we get there, we are going to discuss that. All right then. So, however, the beta of the market is always 1. The beta of the market is always 1. So if the beta of the portfolio is greater than 1, it means that the securities in the portfolio, or the securities in portfolio is more risky than the market. All right. So the security in the portfolio is more risky than the market. So when you look at even the securities you have on this table, you will see that black is 1.32. The beta value of blue is 1.2. Beta value of purple is 1.05. That means security black, blue, and purple are more risky than the market. Only security yellow and white are less risky relative to the market risk. So with this, I can then say this shows that this means that the risk of the portfolio, the risk of the portfolio, or the risk of the portfolio is higher, is slightly higher than that of the market, is higher than the market's risk, which is 1. So market risk is always 1. The market risk is always 1. So if the risk of the portfolio is greater than 1, it means that the security is more risky relative to the market. Okay? So that is for that. Then number B, from the requirements, you have to determine the requirement. Who is speaking, please?
It's Prosper, sir.
Okay, Prosper, talk to me. How are you?
Yeah, I'm fine, sir. Sir, what's the implication of the risk of the portfolio being higher than the risk of the market?
Yeah, it's when you talk about risk, you know what risk is all about, isn't it? Yeah. So if you say the risk of the portfolio is higher than that of the market, what we are trying to say in essence is that that particular security or the risk of the portfolio is higher than that of the market because of the fact that, you have to get a return that will be consistent with the level of risk. So the market, the risk of the return of the market must also be higher relative to the risk of the portfolio. So when you say the security, the risk of the portfolio is higher than the market than that of the market, it means that the portfolio is riskier, it's more risky relative to the market. The market is the benchmark, which is 1. So anything above 1, it means that it is more risky. The security is more risky than the market. When you say something is more risky, you should know the interpretation. So if it is less than 1, that means it is less risky relative to the market. Do you get?
Yes, sir. Thank you, sir.
You're welcome. So let's move to number 2. Number 2 says you should determine the required return on the portfolio. So how do you then calculate the required return on the portfolio? So let's quickly do that. Now, you have to be very careful with these requirements. Examiner wants you to calculate the required return on the portfolio. This required return the examiner is asking you, it simply means the Naira amount. If examiner has put required rate of return, then that would have been a percentage. If you asked to calculate required rate of return, in this case, it has to be your capital asset pricing model. But examiner mentioned to you that you should calculate required return on the portfolio. So to achieve this, 2 things you can do. The first thing is for you to calculate the capping, the expected return of the security in the portfolio. All right. Then you now multiply the percentage with the total market value. So that will give you the required return. Or the second method is for you to do it separately and individually. All right. So let's demonstrate the 2 and see what we are talking about. So I would then say, to calculate the expected return of the portfolio, number 2, expected return of the portfolio. Okay, so how do you do this? Like I said, 2 things, there are 2 options available for you. One is faster than the other. So if I want to calculate the return of the portfolio, the expected return of the portfolio. So the first thing I need to do is to calculate the expected rate of return. Once I get the expected rate of return, then I'll multiply with total market value. That will give me the return in Naira for the entire portfolio. So this is what I'm trying to say. So you are going to multiply. I'll say to get the expected return of the portfolio. Multiply the calculates, multiply the total market value, multiply the expected rate of return, which is capping, with the total market value. Total market value of the portfolio. Okay, this is shown as follows. So the expected return of the portfolio. So I need to first of all calculate my capping. So I would then say capping, which is cost of equity, equal to risk-free rate of return plus the beta of the portfolio multiplied by market return minus risk-free rate of return. So I would then go back to the question, what is risk-free rate of return? We are told that risk-free rate of return is 8%, market return is 14%. Here is 8 plus the overall beta we calculated above is 1.12. 1.12, that's the overall beta. That's the beta of the portfolio, 1.12. Market return is 14% minus risk-free rate of return of 8%. Therefore, the expected rate of return of the portfolio, the expected rate of return of the portfolio will then be equal to, bring out your calculator, please. 4 minus 8, that will be 6. 6 multiplied by 1.12 equal plus 8 equal 14.72%. Here is 14.72%. This represents the expected rate of return of the portfolio. Now that I have the expected rate of return of the portfolio, I need to calculate the expected return of the portfolio. Therefore, expected return the expected return will then be equal to the total market value multiplied by the rate of return of the portfolio. Total market value, we got 126,100, then multiplied by 14.72%. Okay, let me confirm. 126, yes, 126,100. So what do you then have with your calculator? Divide by 100, multiply by 126,100 equal 18,562. 18,562. So this represents the expected return of the portfolio. This is the expected return of the portfolio. So if that is the case, so this is one way of solving it. This is one way of solving it. If I don't want to follow this route, I can do it individually. So alternative solution. Alternative solution. I will create a column for companies. The alternative solution is to calculate capping for individual securities. So once I get capping using the same formula here, once I get cappings for individual security, then I will then multiply with market value of individual security, then I will sum it up. That's all. So to get the capping of individual security, I will create a column for company, then create a column for risk-free rate of return. I will create a column for beta value. I will create a column for risk premium, RM minus RF. Okay, then I will create a column for cost of equity, which is capping for individual security. I'll create a column for market value. Then I'll create a column for expected return. So I have security black, blue, yellow, purple, then white. So the risk-free rate of return, according to the question, is 8%. Here is 8, 8, 8, 8, 8. Then the beta value of individual security for security black, 1.32. Here is 1.32, 1.20, 1.05. Is it? Let me confirm. That's 0.8. Yeah, 0.8. Yellow is 0.8. 1.05, then 0.80. So market return is 14%. Risk-free rates, we got 14 minus 8 is 6. Here is 6. All true. Therefore, to calculate cost of equity of individual security, then I would then say I will multiply to get my cost of equity, because what we want to calculate is using this capping. We want to calculate capping for individual. That's your cost of equity or rate of return on equity. So in this case, I will then say for the first one, I will say 6 multiplied by 1.32. 1.32 equal, then plus 8 equal, that's 15.92%. Here is 15.92%. So I will multiply with market value. What's market value of black? The market value of black is 37,500. 37,500. What's the market value of blue? 39,600. 39,600. $19,000. Then the next one, 18,000, 12,000. 18,000, 12,000. Therefore, in this one, 15.92%. 15.92%. So I will quickly multiply with that. 15.92 multiplied by 37,500. 5970. The return of black is 5970. I'll go to the next one. So 6 multiplied by 1.2 equal plus 8 equal 15.2. Here is 15.2%. 15.2% multiplied by 39,600 equal, divide by 100 equal 6019. Next one, 6 multiplied by 0.8 equal, then plus 8 equal 12.8%. 12.8 multiplied by 19,000 equal, divide by 100 equal 2432. Next one, 6 multiplied by 1.05 equal plus 8 equal 14.3%. 14.3 multiplied by 18,000 equal, divide by 100 equal 2574. 2574. Then the last one, which is 6 multiplied by 0.8 equal plus 8 equal 12.8%. 12.8% multiplied by 12,000 equal, divide by 100 equal 1536. Here is 15 36. So all I need to do now is to add up all the returns. Okay, I need to add up the returns. So that will be it. So let's add it up. Plus 2574 plus 2432 plus 6019 plus 5970 equal 18531. Here is 18531. The first one, the first method we use, we got 18562. So the difference is due to rounding. The difference is due to rounding. So this is what examiner wants you to do, and that's what we have done. All right. So let's see. We can have one more illustration before we close it for today. So tell me, do you have any question? Any question for me so far? Do you have any question for me? Okay, so in the absence of no question, I will stop sharing this. Let's see if we can solve one more illustration. All right. Let me stop sharing this. Let me know if you can see my screen, please. Can you see my screen? Can you see my screen, please?
Yes, sir.
Okay. So let's have another illustration. What happened? Debbie did not join today. All right, let's move on. So let's have one more illustration. Illustration 2 and 3 are similar, but one is not easy, than the other. So let's solve this illustration number 3. It's more technical. All right. So please, who will read for us? Illustration number 3. Somebody should read for us, please. Yes, who is reading?
Okay, let me read.
Please go ahead.
Okay. Johnson has 100,000 from Baba Ejibole Lottery Limited and has decided for the interim to place the money on 2 security X and Y for a period of 1 year. 60,000 is to be placed on security X and the balance on security Y. He has estimated returns that cash flows to be received at the end of the year plus project value at that time. And the probability of the 3 possible states are as follows. So are you there?
Yes.
States, probability. Okay, yeah. State probability
Required.
predicted returns on the end of the year. Required, calculate the expected return, variance, and standard deviation of each security. B. Calculate covariance between the two securities and the correlation coefficient.
Okay.
Correlation coefficient. C. Using the general formula for the mean return on variance of two securities periodically calculates the mean return variance and standard deviation of this portfolio. E. Could your answers to D above be different if the correlation coefficient had been positive, has been positive 1 plus 1 plus 0.5 minus 1? What conclusion do you draw? That's it, sir.
All right, thank you, Fidelis. So that's that. So in the A requirements, examiner wants you to calculate the expected return variance and standard deviation of each security. So let's see if you can complete this question tonight before we call it a day. So let me stop sharing this and move to the working notes. So illustration number 3. So in that illustration number 3, you are required to calculate expected return variance and standard deviation of each security. You will notice that in the table given to us, we are given probability. The first column the first column is state of nature, states A, B, and C. Then you have probability. We are given security X and Y. So because security X and Y have the same probability, it means that there is a relationship between security X and Y. So we need to establish that relationship first. However, you will also notice that the return given to us for security X and Y are in absolute value. So you need to convert that absolute value to percentage because you don't use absolute value in portfolio. Rather, you are supposed to use percentage. So we need to first of all convert those absolute value to percentage. That should be our first workings. Therefore, once you are done with that, then you can then proceed to calculating the expected return, variance, and standard deviation of each of the securities. So in this case, I would then say, like I said, the first working that you are going to do should be to calculate the return in percentage. So I would then say calculating returns in percentage. So return will be calculated as value at the end minus value at the beginning divided by value at the beginning. Okay, of course, multiply by 100 over 1. So for each state of nature, the first we have security X. Security X, state A, B, and C. For state A, value at the end. When you go back to the question, let's go back to the question. We are told that Baba Johnson has just won 100,000 naira from Baba Ijebo Lottery Limited. So you are now told that out of the 100,000 naira, 60,000 naira will be placed on security X. So 60,000 is the amount invested on security X. That is the value at the beginning. That is the value at the beginning. An examiner also told you in the table that predicted returns at the end of the year, 75,000. So for state A, I have 75,000 naira minus value at the beginning, which is 60,000 we are investing on security X. All of that divided by the value at the beginning, which is 60,000. Therefore, what do you have in percentage? I will do the same thing for state B. Under state B, how much are we investing? In state B, for security X, value at the end is 73,200. Okay. 73,200 minus value at the beginning of 60,000 divided by value at the beginning of 60,000. What do you have as your percentage? Are you still there? 67,200 minus 60,000 divided by 60,000. What do you have as your percentage? Prosper. Anyways, 15,000 divided by 60,000. That's 25%. 13,200 divided by 60,000. 22%. Next one, 7,200 divided by 60,000. 12%. Okay, so I will also do for security Y. At states A, B, and C. So go back to the question. If you are investing 60,000 on security X out of 100,000, it means that the balance of 40,000 will be invested on security Y. Therefore, value at the end for state A is 45,600. Here is 45,600 minus value at the beginning, 40,000 divided by 40,000. Then for state B, 47,200 minus 40,000 over 40,000. For state C, we're investing 48,000. Sorry, value at the end is 48,000. Value at the beginning, 40 over 40 equal. So 56 divided by 40,000. That's 14%. 72 divided by 40,000. 18%. Oh, this one is not 40. What do you have? The 48. It's supposed to be 48,000. Okay, write it again. So 8,000 divided by 40,000. That's 20%. So now that we have your returns in percentage, we can then proceed to answer the question properly, which is to determine return. Okay, we need to determine return, variance, and standard deviation of individual security. I would then say calculating returns, expected return, variance, and standard deviation. Standard deviation of individual security. So let's say this is security X. For security X, what are you supposed to do? You create a column for the state of nature. You create a column for the probability. You create a column for the return. Then you create a column for expected value. This is P. This is X. This is X bar. Then this will be X minus X bar. X minus X bar squared. Then probability of X minus X bar squared. Let me write that too properly. Okay, then. So I have states A, B, C. So probability of the securities are 0.3, 0.45, 0.25, 0.3, 0.45, 0.25. Return of security X, we've already computed that. 25, 22, 12. 25, 22, then 12. Therefore, to get the expected return on security X, remember what I told you earlier today when I was giving you the formula. I said expected return denoted as Rx in this case will be equal to summation of probability of X. That is, you multiply probability with your return. Therefore, 0.3 multiplied by 25, 0.3 multiplied by 25 equal to 7.5. Here is 7.5, 0.45, 0.45 multiplied by 22 equal 9.9. Then 0.25 multiplied by 12 equal 3. So you add it up. This will represent the expected return on security X. So what do you have there? You add it up, 7.5 plus 7.5 plus 9.9 equal 20.4. 20.4 is the expected return on security X. So to get the variance of security X, I need to extend the formula. Remember, I told you earlier today that standard deviation, let me write it down here. I said earlier today that standard deviation, in this case for security X, will be equal to square root of variance. And variance is summation of probability of X minus X bar squared. So this particular formula is what I've expanded to this. Okay, that's what I've expanded. So for us to get the variance, I need to multiply, I need to minus X minus X bar. This is X bar. 20.4 is the expected value of security X. Therefore, 25 minus 20.4. I will say 25 minus 20.4 equal 4.6. Here will be 4.6. 4.6 squared. 4.6 squared equal to 21.16. 21.16 multiplied by probability of 0.3 equal 6.348. 6.348. Let me write that 3. So next one, 22 minus 20.4 equal, sorry, I got it wrong. 22 minus 20.4 equal 1.6. Here is 1.6. 1.6 squared equal to 2.56. 2.56 multiplied by 0.45. equal 1.152. 1.152. The last one, 12 minus 20.4 equal minus 8.4 minus 8.4 square equals 70.56 multiplied by 0.25 probability. 0.25 equal 17.64. So let's add it together. 17.64 plus 1.152 plus 6.348 equal 25. Here is 25.14. This represents the variance of security X. So let's calculate variance of security Y. Before that, let's compute the probability, the standard deviation of security X. So to get the standard deviation, I would then say square root of 25.14. This is standard deviation. Okay. So go back to the, I would then say square root. Square root of that is 5.01. Here is 5.01. Okay, so the standard deviation of the risk of security X is 5.01. So let's do for Y. So that's where we are going to stop. So security Y. States probability, then return, then expected value. Here we have Y minus Y bar, Y minus Y bar square, the probability multiplied by Y minus Y bar square. So P Y Y bar. Okay. State A, B, C. Probability is the same. 4, 5, 2, 5. Please, like I said earlier on, at all time, your probability must be equal to 1. The probability must be equal to 1. So the return of security Y that we calculated was 14, 18, 20. 14, 18, then 20. To get the expected value for security Y, I would then say 0.3 multiplied by the return of 14%. That's 4.2. 0.45 multiplied by 18 equal 8.1. 0.25 multiplied by 20 equal 5. Add it up. This is 17.3. This is expected return on security Y. Okay? Expected return on security Y. So to get the variance, I would then say 14 minus 17.3. 14 minus 17.3 equal 3.3 minus 3.3 minus 3.3 square. 10.89. 10.89 multiplied by 0.3 equal 3.267. Next one, 18 minus 17.3 equal 0.7. 0.7 square, 0.49 multiplied by 0.45 equal 0.2205. Next, 20 minus 17.3 equal 2.7. 2.7 square, 7.29. 7.29 multiplied by 0.25 equal, oh, there's an error there on my calculator. So 7.29 multiplied by 0.25 equal 1.8225. So let's add them together, plus 0.2205 plus 3.267 equal 5.31. Here is 5.31. So the variance of security Y is equal to 5.31. So if that is the case, I need to go ahead and determine the standard deviation of security Y. I would then say standard deviation of security Y is simply square root of 5.31. So what you get, square root 2.30. Here is 2.30. That represents the standard deviation of security Y. Okay. Let me hear your opinion. Hello, guys. Do you want us to stop it here tonight so that we can continue next time to complete this question? Then we move to capital Z pricing model. So far, any question for me? Any question for me? So we have only solved requirement number A. We've only completed requirement number A. We are moving to B, C, D, and E. So, and it's already past 11. I don't want to overburden you. So I want to suggest that we call it a day. So in our next class, we'll continue from where we stopped. All right. So thank you everyone for your time and understanding. I will see you next time by the grace of God.
Thank you, sir.
You're welcome. Good night to everyone.
Thank you, sir. Good night, sir.
Yeah, good night, bro.